As investors grapple with the worst-performing market in years, some experts have zeroed in on Wall Street's so-called fear gauge as an indication that stocks have more room to fall, even as major indexes flirt with bear market territory, while many investors are focused on finding the market's bottom. Just because a market bottoms, doesn't mean it's headed right back to record highs. Fresh off the stock market's worst quarter since the COVID downturn 2 years ago, many experts still aren't convinced a recession is in the cards this year. However, some are cautioning the risks could keep rising through next year as the Fed eases stimulus measures, signaling more bad news for stocks. In a client note last week, Morgan Stanley analyst Michael Wilson warned that mounting evidence showing economic growth is slowing more quickly than feared sparked an especially vicious end-of-month stock sell-off and likely isn't over. Wilson predicts the S&P, which has already plunged 17% this year, could plummet another 13% before it bottoms out. Stocks will likely find a bottom when the Fed signals a pause in its tightening campaign, or inflation shows signs of moderation, Schein says. The Consumer Price Index report is slated for release Wednesday morning. Economists estimate prices rose at about 8.1% last month, down from 8.5% in March, but still far higher than the Fed's target of 2%. Meanwhile, the Fed's not slated to meet again until June 14. Over the past 11 recessions, the S&P declined between 14% and 57% peak trough, at an average of 27.5%, according to Bank of America. Technicals point to more stock market carnage ahead. Forbes stocks could plunge another 15% after Fed-Spurred Selloff. Will the economy fall into recession?